We've actually been established since 2008 as a traditional independent asset manager, and we run about $3 billion US for about 120 families globally. Our London and Monaco offices do still continue to do traditional wealth management, as do we here in Singapore. But the call that we got from our client base to begin examining the digital area, we found offered us also the opportunity to maybe expand our offering or democratize some of what we've learned serving the ultra high net worth and bring that down to the accredited investor level here in Singapore. As to how we differentiate ourselves, our business is founded on the independent asset manager model. So transparency and open architecture were very important as we built our business. And it allows us to help our clients, our traditional clients, get treatment more as an institution than as a family office account in terms of pricing from the banks. We've carried that through a bit as we've built the Connect platform for online, and we've made sure to find sort of best of breed partners and best of breed product to get out into the market and to give access to some of what only the ultra high net worth had access to previously. Sure. So when we decided on the first offerings to put through the Connect platform, we went through many possibilities, and the biggest issue we had initially was that all of the other digital advisory models around the world, from the US, from Europe, and now here in Asia, tend to put their clients into a portfolio of ETFs, which is fairly easily done on the management side, on the investment manager side. What we weren't crazy about there was the idea of stacked fees. So there's fees in the ETFs, and then they're being charged additional fees by the digital advisor. So we worked pretty hard on coming up with a new structure we think is a little bit more efficient, where we put the portfolios into a digitally available, actively managed certificate. In order to do that, we needed an issuer. So we shopped around in the street, and we compared both issuer quality and pricing, and tried to find the most appropriate issuer for the client. And we did select Julius Baer. They have been extremely proactive in helping us to build the product and to issue the product. I'd say the operational difficulties are that we're the first to do it. So we need to explain to our custodian how the product works and how it's priced. We needed to come up with a new method of pricing so that what would traditionally be a less liquid product became a more liquid product. So we decided to structure it from a pricing point of view more like a mutual fund, where you have daily trading at net asset value with no bid-offer spread, which we thought was pretty compelling. We believe very strongly that we're a hybrid model, and we're going to remain a hybrid model. In fact, we say digital advisor instead of robo-advisor. I think one of the misconceptions in the market is that the robo-advisor involves a robot, some artificial intelligence calculating asset allocation in the background. That doesn't happen. Right? We're not there at the moment. I think the most advanced AI on the planet is equivalent to a rat at the minute. I don't want a rat selecting my portfolio. So will that come? Yeah, absolutely. I think we're years away, 10 years away from a self-aware artificial intelligence. Right. So until that time, there are going to be humans involved, whether we see them or not. We think it's more important to the clients, especially on the higher net worth side, that there's always a human involved. We may be able to offer really good diversified portfolios, but there's going to be custom work that the client's going to want and custom advice they're going to want that they're not going to want to get through a machine.